Hey, today we're going to be doing something a little different. We've got a guest here today, and I don't mean a guest that I'm interviewing, but someone who's guest hosting. And that is my good buddy, Paul Moore. He is managing director of Wellings Capital, and he is stepping in for me today to talk about self storage investing. Now, this is a popular asset class. I'm sure you've thought about it, heard about it, and he's going to go through a whole bunch of things. Some of the key takeaways will be what's driving the boom in self storage, the 4 Ds of self storage, which are death, downsizing, dislocation, and divorce, self storage facilities around the United States, the value formula in commercial real estate deals, how self storage is recession resistant, and he'll talk about dynamic pricing and ancillary income and additional value adds like boat, RV storage, and truck leasing. So listen in. I think you'll enjoy it. And if you haven't done so already, be sure to register for upcoming Creating Wealth virtual event. It's live but virtual, so you can attend from anywhere in the world, and it's super affordable because it's a virtual event. So go to jasonhartman.com. That is coming up fast. jasonhartman.com for our Creating Wealth live and virtual event. Here's Paul.
Hey, I'm Paul Moore, and I'm really excited to talk with you today about why I love self-storage and why it's gone bonkers in the headlines recently. Have you seen what's going on? Since COVID, self-storage has hit the headlines in the Wall Street Journal, New York Times, etc. And they're talking about the boom in self-storage that's resulted from the pandemic, the economy, supply and demand, etc. Today, we're going to talk about what is driving this and what I love about self-storage. Before we go on, I just want to mention, if you haven't jumped into jasonhartman.com and got Jason's complete solution for real estate investors, you need to check it out. Go over to jasonhartman.com and see what he's got going there. So I have been in real estate investing for about the same time as Jason, a couple decades, and I have done residential, I've flipped waterfront lots, I've bought and sold land, I've done a subdivision, I did a hotel, did multifamily, and I ended up writing 3 books on real estate investing. My newest book is called Storing Up Profits: Capitalize on America's Obsession with Stuff by Investing in Self-Storage. You can get that book at biggerpockets.com/storage. So let's jump right in. The New York Times recently had a headline called "A Pandemic Space Race, Self-Storage Roars Back." And the Wall Street Journal had an article as well called "Self-Storage Bounces Back Ahead of Others as COVID-19 Eases." Another headline I noticed was "Why Self-Storage Endured Through COVID-19 and is Well Positioned for the Future." That's on Arbor Crowd. So self-storage has done remarkably well through the pandemic and in the last couple decades in general. And it's partly based on this unfortunate situation called the 4 Ds. That's death, downsizing, dislocation, and divorce. And there's a lot of that going on. And the fact that we've been saying for years, self-storage is recession resistant, has really been borne out during this pandemic and in these recent strange times we've lived in. I mean, think about it. When the pandemic hit March, April of 2020, college students packed up en masse. Some of them didn't know if they'd be coming back in a month, others in the end of the summer, others graduating. They put a lot of stuff in self-storage. Since then, companies have found out they can operate with workers who are working out of their homes. And so they have packed up a lot of office stuff and put it in storage. Restaurants have shut down, bars have shut down, lots of businesses have closed their doors and they're using self-storage. So we're talking about dislocation here. There's also been unfortunate situations with death and divorce. And, there's downsizing going on. There's a lot of stuff going on. So that's been driving a lot of this. There's a lot of underlying fundamentals that drive self-storage, and we're going to talk about those today. So the self-storage industry has about 50,000 plus or minus facilities in the US. Almost all the self-storage in the world is in the United States. And again, that reflects our obsession with stuff. Now, that's similar to the number of Subway, McDonald's, and Starbucks combined. Yet, it's a very fragmented industry. About 75% of these self-storage operators are independent operators, and about 2 out of every 3 of those are mom and pop owners, typically meaning that they have 1 or at most 2 facilities. These folks don't typically have the knowledge, resources, or the desire to increase income and drive maximized value. So an operator who goes in as a pro can pay them a good amount of money, perhaps even top dollar, and acquire this facility, increase the income, increase the value accordingly, and significantly increase the owners' and investors' wealth. We all know the value formula in commercial real estate. The value is the net operating income divided by the cap rate. And so as the cap rate stays steady, as the NOI goes up, the value of the facility goes up proportionally. But Jason talks a lot about the use of these historically low interest rates to create significant wealth by using significant but safe leverage in these commercial real estate deals like self-storage. That value formula gets leveraged. So a 20% increase in net operating income, which is easily doable when acquiring a lot of these mom and pops, turns into perhaps a 50 or 60% return to the equity investors. And so there's lots of other ways to create value. When I first heard about value adds in self-storage, I laughed. I mean, wait, there's 4 pieces of sheet metal, some rivets, a floor, and a door. Where are the upgrades? Where are the cabinets, countertops, paint, lighting, etc.? Well, they're there, trust me. And I might do another episode on value adds in self-storage. But the fragmented industry is what I love most about self-storage. Self-storage, like I mentioned earlier, is recession resistant. I mean, in down times and bad times, people are often putting their stuff in self-storage. But in economic booms, people are filling up their Amazon carts and their Walmart carts, and they need a place to store their stuff. And self-storage is a relatively low-cost solution for a lot of people. Speaking of cost, the rents are generally price inelastic. That means the tenants aren't particularly price sensitive. If I have a $1,000 a month apartment and my landlord raises the rent by 6%, yeah, I might leave rather than pay that $60 a month or $720 a year to stay there for a year. But if I have a month-to-month lease at $100 on a self-storage unit, the landlord raises the rent by 6%. I probably won't get a U-Haul, spend a weekend, get my friends together to move my junk, my treasures down the street, just to save $6 a month, especially when I have this perception that I won't be there that much longer anyway. It's a month-to-month lease, and typically that $6 gets added to the next, and the tenant's still there months or years later. So the prices are relatively inelastic, which we love. Another thing we love about this, and this is where Jason does such a great job drawing this out, self-storage is an inflation capturer. Now, what do I mean by that? Here's what I mean. If you have a industrial facility or a large warehouse that's leased on a 10 or 20-year term, it's going to be hard to capture inflation. That lease is locked in and the tenant is the one benefiting. But self-storage is the complete other end of the spectrum. They have monthly leases. So on a month-to-month lease, they can raise the rents and capture that inflation. Self-storage captures inflation better than any other real estate asset class I'm aware of. And we love that. We also love the fact that There's a misperception about self-storage. And again, this is something to do with the fragmented ownership. Some people will buy. I had a couple $1 million in 1997, and I thought about buying a self-storage facility. I thought, oh, that's just going to throw off cash. No hassle. Well, it is easy to manage a mediocre self-storage facility, but it's hard to manage a great one. And that misperception that it's just a coupon clipper or a cash cow means there's a lot of operators out there who are doing just that. Acquiring from them and turning it into a great facility is a wonderful opportunity. I mean, here's an example. You know that when you go to a hotel or get on an airline, you're probably paying something different from the person in the next seat or the next room because they use dynamic pricing to capture demand, to capture when you book, how many people you book, what type of room or seat you book. Well, it's the same in self-storage for great operators. Great operators can actually go in and they can actually reconfigure units. I mean, you're just popping rivets out and taking a wall out to create a larger unit, or you might be adding a door and a piece of sheet metal to create more smaller units. A mom and pop operator, they just don't think that way. They don't think about dynamic pricing. They don't think about charging someone different on a Tuesday afternoon than they do somebody else on a Saturday morning. But this is all legal and it's all doable by great operators. And so by investing with one of these great operators or becoming one yourself, you can capture a lot of this potential upside. There's also a lot of opportunities for significant ancillary income. And so, for example, if you set up a nice showroom, not only can you have a place to help upgrade your tenants to a larger unit, but you can also sell locks, boxes, tape, scissors. You can, charge, you can sell them insurance, and you can get a cooperative arrangement on that insurance. These are great low-cost value-add ancillary income items. And speaking of value adds, there are some other great things you can do, like adding boat and RV storage. We all know that since the pandemic, boats, RVs, and other items like that have just become extremely popular. Well, a lot of self-storage facilities have some vacant land they're not using. Some of them are using 2 or 3 acres and they have 5 or 10 acres vacant out there. Well, you can add incrementally gravel or pave an area that you lease to these recreational folks, and you can get a lot of income from that. Some of these are commercial folks who need a commercial space for their truck, like some of these, realtor moving vans. Another upgrade is using that vacant space to bring in stackable units, these portable units. I know a guy making $200,000 a year extra from just having these stackable units on site. Well, $200,000 in income divided by a 6% cap rate is well north of $1 million in increased value. It's approaching $2 million in increased value. And this is a pretty powerful upgrade that a lot of self-storage facilities are doing right now. Here's another one, truck leasing. You see U-Hauls leased out of non-U-Haul facilities, and there's a chance to get a self-storage facility, check out the demographics, and then sign a lease arrangement with U-Haul. Now, adding U-Haul can increase your income up to $5,000 a month. North adjacent in Rockledge, Florida, I've got a friend who has a self-storage facility. He gets $5,000 a month in commission from U-Haul. $5,000 a month. That's $60,000 a year. Divide that by a 6% cap rate, and we're talking $1 million in increased value. Quite a powerful opportunity for self-storage facilities. And again, you're talking about increasing the value of a facility and the return on investment to the investors just by signing a lease and implementing that. So we love the low-cost value adds. We love the flexible lease terms. Flexible lease terms also lead to easy evictions. There was an eviction moratorium we've all been dealing with off and on for the last year and a half in the US. Well, that eviction moratorium doesn't apply to people's stuff. In fact, we're basically leveraging the fact that we have their stuff and they usually want to keep it. They usually don't want to see it auctioned off. And so they usually pay their bills, but it's easy to evict them. It's not like evicting the person out of a rental unit or apartment. This is an opportunity to basically have a tenant that doesn't cause as much trouble. You're not dealing with toilets. You're not dealing with some of the tenant issues we have in apartments and such. And this is one of the things I love about self-storage. Another thing I love is this institutional craze. There's a lot of institutional investors, family offices, life insurance companies, et cetera, that are running after self-storage right now. So by building a portfolio of self-storage facilities that have the same management, the same flag, the same property management systems and people, you can actually sell that portfolio for a premium, meaning a reduced cap rate, to an institutional investor. And by doing that, you can get significantly higher returns for investors, and you can build an empire of multi-generational wealth. Speaking of multi-generational wealth, have you checked out Jason's video on his homepage about how to analyze a real estate investment and read a pro forma? If you haven't, you should check it out, because this is one of your first steps in getting the knowledge you need to invest either actively or semi-passively, nothing completely passive, in a commercial real estate deal, a residential deal, etc. So go check that out at jasonhartman.com. Check out my book on self-storage at biggerpockets.com/storage. I'm Paul Moore from Wellings Capital. Have a great day.